Inflation is down, let's all celebrate. Or should we actually? There's something very positive happening, and that's the inflation rate is now coming below the interest rate. That's what we're seeing in this chart. So the US inflation rate in green, the target Fed funds rate in blue. And what historically happens whenever this cross is here, historically the Fed gets less hawkish then. So in other words, interest rates are less likely to go further up from here, because the whole idea is the Fed should keep monetary stability. It needs to protect the value of the US dollar. And when there is already a real return, real as in nominal minus inflation rate, and there's already a real return on government bonds, then there is no real need for further monetary tightening. So in other words, I expect that this crossover here marked the beginning of setting the terminal rate, or in other words, the rate at which the Fed will not go higher from here. We have seen this in the past. Here, look at November of 2006. We had been raising and raising rates, and then we stayed at this elevated level from July of 2006 to June of 2007. Roughly 1 year. And this is probably what's going to happen again. The Fed will keep the rate until something breaks. Now, we've already seen small local banks collapsing and then getting propped up, but I mean something more serious breaking, right? Like unemployment shooting up potentially, or maybe a real crash even in the property market, because now demand for properties is low. It's very hard to finance property because of the high inflation rate, but also because the prices didn't come down that much. Now, the market is agreeing to a certain degree, at least for the next meeting. The meeting today. So here's the data. The meeting on the June 14. What's the probability that the target rate will go up by 0.25%? That probability, according to this investing.com monitor tool, is at 18%. Now, according to the CME group, it's even lower. Here we've got the probability at 5.8%. I don't know where the difference comes from, because they both look at the same meeting and they both refer to the 30-day Fed funds futures pricing data, right? This is where these probabilities are derived from, right here, the 30-day Fed funds futures price. So not sure where the delta is coming from, but the message in general is clear. After the positive inflation data, the Fed is likely staying at that current rate. And I would go so far to say that this is actually a long-term thing, because there's also another rate. It's an unofficial rate. There is this thing called trueflation. So that's on trueflation.com. And look at this. This is the inflation rate of the US. And according to trueflation, it's at 2.5%. Now, what's trueflation? It still looks at the same basket of goods, right? Inflation rates get measured in terms of consumer prices, right? So you're looking at housing, at transport, at utilities, and you've got different inflation rates for each of those different constituents of that basket. What's the difference between this inflation rate and the official inflation rate? The difference is that trueflation tries to measure these numbers on a more real-time basis. So the official numbers, they simply, for example, just make surveys for, like, what do you think is your house worth? What do you think? How much could you rent this out for? It doesn't really look at market data, but trueflation does. Trueflation updates this estimate for the same kind of basket every day. And this is encouraging, because this would in turn imply that the official inflation rate is likely going to go even further. Thus, when inflation rates that get officially measured go further and further down, how much reason does the Fed really have to further hike the rates, right? They're only hiking because of high inflation rate. Are they going to come down with the Fed funds rate? Probably not, because they're rather too cautious and rather over tighten than not tighten enough. So basically, to have some kind of buffer if a recession really hits, they can potentially lower this a little bit longer without hitting the zero mark, right? This was always the risk after the global financial crisis. You couldn't stimulate the economy that much anymore because you couldn't lower rates. You had to do quantitative easing. You had to buy up bonds using the Fed balance sheet. The Fed tries to avoid this. They try to just use interest rates as an instrument. That's the primary instrument. They've got more wiggle room to do so if the interest rate rather tends to be too high than too low. So what I think is most likely, I don't have a crystal ball here, right? But if you want to know my opinion, what's most likely is we stay at this rate and we stay at this for a long time until something breaks, until the economic outlook isn't that great anymore. But right now, everybody is partying. Right now, even tech stocks are only 10% away from their all-time highs in aggregate. Things still look healthy, but different times are likely going to come. Especially the property market doesn't like these interest rates. I'm not saying that we will see exactly a repetition of the global financial crisis, but it does look like there's still some danger looming, especially in commercial real estate. What does this all mean? In the end, nobody can say for certainty where things are headed, but spread your risk. Don't get overly excited. Try to diversify, especially across different asset classes. So just having different stocks doesn't help that much. You want to own stocks, but you also want to own a bit of property. You also want to own a bit of precious metals and maybe also a bit of crypto, especially Bitcoin, right? Bitcoin seems to be safe even in the eyes of the SEC. You want to spread across all those different asset classes because the correlation between asset classes isn't as high. As in, when stocks go up, it doesn't necessarily mean that property goes up. Or when gold is down, it doesn't necessarily mean that Bitcoin is going down. So you reduce the overall portfolio volatility by owning all of those things. No matter what's going to happen, you will be somewhat safe. That's probably the best way forward since the current situation isn't that clear. Please give this a like and feel free to subscribe as well. I publish videos here regularly.